This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, we're moving on in now to capital maintenance. And so far as we need to know about capital maintenance for the purposes of F4, it's a topic which does come into F7 and therefore also further on into P2. So it's a financial accounting topic, but there's also the legalities of it, which are of clear importance for the F4 paper. So if we think about it, capital, we're looking at the capital of companies. This doesn't apply to partnerships and sole traders. They can do what they want. Basically, they can have negative capital and effectively head towards bankruptcy. But the concept of capital maintenance is for companies to always have, this is the theory of what it was trying to achieve. They should always have sufficient net assets to be described as net assets rather than to have net liabilities. And the concept, the purpose of capital maintenance is to make sure that there are always positive assets and therefore creditors will always be paid in full. And that's the theory, that's what the law was trying to achieve. But just in one line, you cannot legislate against companies making losses. And so that destroys really the effectiveness of what it's trying to achieve. But anyway, we'll have a look and we'll go through. And I'll put some figures on it as well so we can maybe see a little bit clearer what's happening. In fact, I'll do that straight away. Imagine we have a company with share capital. And I'll keep the figures very simple, 500. And we have share premium, we'll say 200, and a revaluation reserve of 150, and then we have retained earnings. What have we got so far? 850. Let's say 250 retained earnings. So that gives us 1100, and that's net assets, isn't it? If you remember your F3 learning with John and John's lectures on the basic F3 paper, you'll see that capital equals net assets, and capital always does equal net assets. For sole traders, for partnerships, for any business, capital always equals net assets. If anything, that is the fundamental accounting equation. Capital equals net assets. So that's what we have, that's what we're looking at here. And there's a thing called the buffer fund, the creditors buffer fund. And the creditors buffer fund is comprised of capital plus undistributable reserves. And in this example, the creditors buffer fund is there. It's 850. And it's made up of capital, the 500, plus these undistributable reserves of share premium and revaluation reserve. And then the retained earnings, therefore, is distributable reserves. So I'm going to classify these two together as undistributable reserves, and this one is a distributable reserve. And when it talks about distributability and undistributability, we're looking at distributions to the members normally by way of dividend or possibly by way of capital repayment, but distribution to the members. And so in this company, this very simple company that we have here, the maximum payout by way of dividend would be 250, because this other 200 and 150 are undistributable reserves. They cannot be paid out by way of dividend. So we cannot use them to finance the payment of a dividend. So let's go back now to the writing. Members contribute capital to the company, and in our case, they've contributed 500. This should be maintained within the company by way of net assets. Well, it is. It's part of the 1100 net assets, and so it's being kept within the company. Imagine if it were paid out. If you were to take 500 of this money and pay it out to the shareholders and pay off the share capital, then there's nothing potentially left. There's no potential losers in terms of, in the event of a liquidation, the last people to be paid out will be the members. So if we happen to be making losses here, and we have sustained a period of heavy losses, therefore we have a debit balance on retained earnings. If we've only got a little bit of cash and we pay it out to the shareholders, then it means our creditors, our payables, will not be paid in full. So that's the reason. And back again up here, the members contribute capital to the company. This should be maintained by way of net assets, and it's known as the buffer fund. And the buffer fund is shareholders' equity, and it comprises share capital plus undistributable reserves. These are reserves that are not capable of being, not allowed legally to be distributed by way of dividend or repayment to the members. The undistributable reserves are statutorily defined, and the statute actually names two of them, and it says it identifies these two as the share premium account and the capital redemption reserve fund. Capital redemption reserve fund. Now, those two are specified in legislation as being undistributable, but the expression undistributable includes two others as well, and that is accumulated unrealized profits less accumulated unrealized losses, and that includes the revaluation reserve. Because we've revalued, we've seen that our assets hopefully have increased in value, so we've debited the asset and credited a revaluation reserve, and that's an unrealized profit, less any unrealized losses if we've had to write them back down again. And finally, and it's a catch-all, any other reserve identified by the Constitution as being non-distributable. It may say in the Constitution, in our Articles of Association, it may say, in the event that the company creates a plant replacement reserve, then that plant replacement reserve shall be deemed to be non-distributable, in which case any other reserve which according to the Constitution is undistributable is undistributable. The development of the principle of capital maintenance addresses three areas: the payment of dividend, the potential reduction of capital, and assistance given to outsiders to purchase the company's shares. So it's giving money to outsiders who will then use that money to buy the company's shares. The effect is the company is buying its own shares, and that's not allowed. I say that, but later on in this chapter, maybe in this lecture, maybe the next lecture, you'll find actually that it now is possible for companies to buy their own shares, but only in exceptional circumstances. So that's where we're up to, and we'll look at these restrictions on dividends, restrictions on capital. We'll look at those right now. Just remember these figures: the 500 share capital, 200 share premium, 150 revaluation, 250 retained earnings, giving me net assets of 1100. But I'll just play, before we move on, I'll just play with this and say, what happens if we have retained earnings of 250 negative? That will then give me 600. Agreed? So 5 plus 2 plus 150 minus 250 gives me net assets of 600. Now then, if I take 500 of that net assets and pay off the shareholders, that means I'm only going to have 100 net assets left. So my poor old payables, my creditors, are really suffering a bit there. They're on tenterhooks as to whether or not they're going to be paid. Remember, this is net assets, so there will be assets available. But now I'm going to change it again. And what happens if we have, that's 850. What happens if we've got accumulated deficit of 1,000, retained earnings of 1,000, negative, that will give me 150 net liabilities. Net liabilities. Net liabilities gives me assets of, say you've got 700 assets and 850 liabilities. That gives me net liabilities of 150. So now the company's saying, oh, we're in trouble here. Let's take 500 of that and pay off the shareholders, and then turn to these liabilities and say, sorry, we can't pay you in full because we only have 200 assets. That's why you can't make that distribution out of non-distributable reserves, the undistributables. So the idea of the buffer is to try and maintain that. And you can't legislate against companies making losses. So long as there's no loss makers bigger than 850, so long as there's no accumulated losses bigger than the buffer fund, in theory, the creditors will be paid in full. 850 buffer, 700 accumulated losses, we have net assets of 150. That means the creditors ought to be paid in full because net assets in excess of liabilities. That's why we have the buffer, but that's why the buffer can fail, because companies do and can make losses. Capital maintenance, the payment of dividends. The general basic principle is that dividends cannot be paid out of profits which are available for the purpose, distributable profits. So the power to declare dividends given to the directors, it's not an automatic entitlement. Even with preference shares, it's not automatic entitlement. The dividend has to be proposed by the directors, voted on by the members in general meeting, but then if it's not paid, then it's a deferred debt. But it has at least to be proposed and voted on and approved and declared, therefore, by the members in general meeting. Because if the directors fail to propose it, even though it may be a cumulative preference share, it still has to go through that process of being proposed and declared payable by the members. So the power to declare is given to the directors. Members don't have an automatic right to a dividend, not even cumulative or not even preference shares with their fixed rate of dividend. Not even they have an automatic right. It has to go through this process of proposing and declaring. At a general meeting, one of the elements of ordinary business is to approve the dividend which the directors have proposed. So the directors put it into the agenda to discuss and, if thought fit, to pass as ordinary business the dividend that has been proposed by the directors. That isn't a liability because it's not been confirmed by the members until we get to the general meeting. At that general meeting, normally the members will approve the dividend that has been proposed. They can, without it being a major earth-shaking change, they may approve a lower dividend. The directors have declared a dividend of 2 cents per share, and the members say, no, we only want 1 cent per share dividend, as if that's going to happen. But that is potentially the case, and that will go through then as a 1 cent per share liability. What members can't do, where the directors have proposed a dividend of 2 cents per share, the members can't turn around and say, look at the size of the profits that we're making. We want 3 cents per share. Let's all vote to have 3 cents per share. You can't do that. What we could do in that situation is adjourn the meeting, call it again with a revised proposed dividend of 3 cents. I've never heard of it happening. But the members therefore can reduce the proposed dividend, but they can't increase the proposed dividend. Dividends are normally paid based on the paid-up capital of the company. Normally 2 cents per share, 1 cent, half a cent, 0.1%. It varies, and the directors look at the results and say, how much dividend should we pay? How much did we pay last year? Did we pay any during the year as an interim dividend towards the payment of a final dividend when we know the final results for the year? How much did we pay? How much do we think we should pay? And that's left in the hands of the directors. There's nothing to do with the members. There's the directors who determine how much dividend or what rate of dividend should be paid. Dividends may be in the form of cash, or they could be in some other form. You can have a distribution of other things in kind. You could distribute assets, for instance. I've never heard of it. What you could do is you could distribute by way of issuing further shares. So if you were entitled to, say, $100 worth of dividend, what you may opt to receive instead is you may opt to receive shares up to that value. So that $100 divided by the market value would give you X number of shares, and you could receive those in exchange or instead of the cash dividend. What it is basically is they pay you a cash dividend and then you use that cash and go out and buy the shares at market value. But this is an availability available to the company where cash, not where wealth or net assets, but where cash is in tight supply. We don't want to have to go and borrow money from the bank. It doesn't cost us anything to issue pieces of paper. So it keeps the cash reserves within the company. A dividend is a company debt from the date it's declared, not from the date it's proposed by the directors. That goes into the financial statements, the annual accounts. They go to the members. We have the annual general meeting, and the members then approve and therefore declare the dividend. And that's the time it becomes a liability for the company. It's not a liability until after the members have approved it. If it's declared and then unpaid, it's a deferred debt. It's most unusual. I don't think I've ever heard of that happening, but that's what it would be. It would be deferred debt. So long as it's been declared and not yet been paid, then it's a deferred debt. Unclaimed dividends, statute barred. It means that if you receive a dividend notification and you don't bank it, you don't take it to the bank, and you leave it for 6 years, you can't then claim it. You can't go back to the company and say, oh, look, I forgot to bank this 7 years ago. What you may be able to do, the company may be prepared to do that for you, but there's no obligation. It's a statute barred debt. Dividends can only be declared out of profits available for the purpose. This is accumulated, this is a short form definition, which is all you'll need. Accumulated realized profits, less accumulated realized losses. Veritasy. And no distinction drawn between capital profits and revenue profits. So if we don't have any profits as a result of trading, we could sell an asset. I could sell this magic pen here. I could sell this pen. It's part of capital. I could sell it for $100. Look, I've made a profit by selling an asset, by selling one of my fixed, tangible, non-current assets, and I've sold it for a profit. Hey, that's now available for distribution. So revaluations do not create distributable profits, but the sale of an asset for an overvalue that achieves a profit, that is available for distribution. Moving on, capital maintenance, reduction of capital. Reduction of capital, a company may reduce its capital, but only under the strictest control. And we need 3 authorities in order to be allowed to reduce our capital. The members need to vote on it by special resolution. So 75% majority of the people voting who vote in favour of the resolution, that would be a special resolution, so long as it is proposed with 14 days notice at a meeting that it is going to be proposed as a special resolution. Fine, away we can go. We have that authority. The second authority requirement is in the articles. We have to have the power within the Constitution that says we are able to reduce our capital. If the articles don't give us that authority, well, all is not lost, because we can pass a special resolution to alter the articles that then allows us to reduce capital if we pass a special resolution to reduce the capital. So the one resolution to reduce to amend the articles to allow us to reduce is often taken to be also the authority to reduce. And then finally, consent of the court. The reason we need consent of the court is because potentially, and particularly in one of the three ways in which we might want to reduce, we are potentially depriving the future creditors and payables of funds which would otherwise have been available to them in the event of a liquidation. So the court has to be satisfied that the payables, that the creditors are going to be protected and will be paid in full. Now we need these three authorities: special resolution, power in the Constitution, and court authority. And the Act then goes on and says, these are ways in which we can reduce capital. They only identify three ways, and these were identified way back 67 years ago, is that right? 1948, 56, 69 years ago in the 1948 Companies Act. But it does say within that Act, which has since been rolled up into more recent Companies Act, it did say within that Act that these are not necessarily the only ways in which capital may be reduced, but these are three examples. Well, that's fine, but in 69 years I've not heard of a single other method of reducing capital than those three methods identified. And the three methods are, they're set out here for you. The company's capital is no longer represented by available assets. So our assets have been run down. We're now facing a situation where assets are lower than capital. So we need to reduce that capital in order to try and get it back into line, which is a difficult and strange concept. But that's the way we can just write off that capital, and the poor shareholders will therefore suffer. So where capital, where available assets are no longer represented by the company's capital, then it's been suffering, therefore it's been suffering losses. The second possibility is where we want to extinguish, and this is the one that affects creditors, where we want to extinguish this, it's called reserve capital. If we've got a $1 share and it's 70 cents paid, then that 30 cents is called reserve capital. And what we can do is because if you're a shareholder and you've got 1,000 of these shares, you've got a 300 liability hanging over your head. And at any time, the company can come along to you and say, hey, you owe us 300. We're going to call up this extra 30 cents that you owe us because you've only paid us 70 cents on this $1 share. So you can be required, you can be asked to pay this additional amount of nominal value into the company, not just you, all the shareholders, to pay this reserve capital into the company. But if the company's got phenomenal assets, it's got $1.9 billion worth of net assets, then why have this threat hanging over the shareholders? Why not just say, look, we're going to extinguish this liability. We're going to take it off. So instead of it being a $1 share, 70 cents paid, why not just call it a 70-cent share, fully paid? And that then takes this sword of Damocles away from you. There's no longer hanging by a spider's thread, ready to fall down on you. So that's the second way in which capital may be reduced. But we have to satisfy the court, because in the event of a liquidation, a liquidator could have come along and said, time you paid us your 30 cents. And he could have asked for this 30-cent difference in order to make up the funds available, in order to make sure that we pay as much as we can to the payables, to the creditors. And the third one, the company wishes to restructure its capital funding. It may want to reduce its share capital and replace it by, for instance, by borrowing heavily. So increase the gearing of the company, take away the shareholders' involvement and increase the involvement of the lenders of the loan capital. It's illegal. Just some quickies, really. Oh dear, what's happened here? There we go. It's illegal to issue shares at a discount. You cannot do it. You cannot receive 90 cents worth of value and issue a $1 share in exchange. It is illegal. Think of the double entry that would have to go through. It would have to be debit cash 90, debit something else for 10, and credit share capital with the $1. And that something else would be discount expense on share issue, but it's illegal. You cannot do that. Public companies particularly, I'll show you a word or two about private companies in a moment, but public companies are not allowed by law to issue shares at a discount. And if they do, directors are liable to a fine, and the person that's received this share capital, which has been issued at a discount, is liable to make good that shortfall, liable to pay in that extra 10 cents. So it's illegal to issue shares for an amount which is lower than the nominal value of those shares. Not lower than market value. If we have got a $1 share and the market value is, say, $3, we can issue shares at any price. We can issue them for more than $3, but why would anyone buy them? But we could issue them for $2.90 or $2.50 or $1.30 or $1.20 or $1.10, but we can't issue them for $99 because that would be issuing shares at a discount. So all the way down, we can issue the shares so long as it's above the nominal value. Where shares are issued, whether for cash or otherwise, for an amount in excess of their nominal value, then an amount equal to that excess shall be credited to the share premium account. Here we have that $3 shares, the market value of $3, and the company wants to issue some more. So let's issue another share at $2.50. So we have debit cash, $2.50. We've got credit share capital, $1, and credit share premium with the, $1.50. So these are being issued in exchange for cash or otherwise for an amount in excess of their nominal value. Then an amount equal to that excess, $1.50, shall be credited to the share premium account. And that share premium account, if you remember, is non-distributable. It's the important non-distributable reserve. In fact, it's so important that the Act actually then goes on and tells us about how we can use this non-distributable reserve. And it has very limited uses. It can only be used for 4 things. Can't use it to distribute because it's non-distributable, but we are able to debit the share premium account in 4 situations, and these are here. To finance the issue of fully paid bonus shares to existing members. Remember, we had share capital of 500, and we had share premium, what was it, 300, wasn't it? On 200. Share premium of 200. And we had other revaluation of 150 and retained earnings of 250. Well, that's the buffer fund. That's non-distributable. But what we can do is we can take that 200 and we can say to our shareholders, we're going to give you a bonus. We're going to give you 2 free shares for every 5 that you already hold. Hey, aren't we the good guys? We're going to give you 2 for every 5. And so what they'll do is they'll debit share premium account, 200, and credit share capital account, 200. So all we're doing is amalgamating those 2 figures. You're not giving the shareholders anything. They're already entitled, in theory, to their buffer fund of 850. After the share issue, after we've capitalized the share premium account by moving it up into share capital, now how much are our shareholders worth? 700 plus 150 revaluation. So that's the primary, that is the primary use of the share premium account. The second one is to write off. Now this only happens once. Writing off the preliminary and formation expenses. So when we have issued shares and we've credited our share premium account, all the time our promoter is incurring expenses. So when we pay cash, we could normally debit this retained earnings with profit or loss account. But we've no profits or losses there at the moment because we're only just starting. What we can do instead is, instead of debiting retained earnings, profit and loss account, we can debit instead the share premium account. And it's it's a one-off, and it has to be of limited availability because how much preliminary formation expenses are there going to be? But that's what we can do. We can write off those expenses. The third use is to provide for the premium payable on the redemption of preference shares or debentures, to provide for the premium payable. So here's our redemption account. This is what we're going to redemption, and we're going to redeem some debentures. So the double entry is debit the debenture account, credited the redemption account, 40. But we're going to redeem these debentures at a premium of 10. So we're going to provide for the premium. We're going to debit the share premium account with 10 and credit the liability. So that now we're going to have this liability of 50, credit cash, and that gets rid of those debentures. We've redeemed the debentures at a premium, and we've provided for that premium by taking it from the share premium account. Which is interesting because that share premium account arose on the issue of shares. It didn't arise on the issue of debentures. And finally, we can write off the expenses of, discounts allowed on, and commissions paid on any issue of shares or debentures. We can write this off. So instead of credit cash, debit expenses of issue, debit discounts allowed on issue of debentures, debit commissions paid on the issue of shares. Instead of debiting those, we can debit those figures to the share premium account. We can write, like we did with preliminary and formation, we can debit them straight into the share premium account. The only thing to remember is that whereas you can issue debentures at a discount, you can't issue shares at a discount. So we've got three things here. We've got the expenses, the discounts, and the commissions on any issue of shares or debentures. So we've got 6 possibilities: shares, debentures, expenses, discounts, and commissions. So we've got 6 possibilities. Discounts on shares is not possible. That's an impossible combination. But otherwise, you've got 5 possibilities there. Despite the principal shares may not be issued at a discount, private companies can. Private companies can issue shares with nominal value of, say, 100, and in exchange receive goods or services that are worth less than 100. So it is available for private companies to issue shares where the consideration received is at an undervalue. But it doesn't mean that we have to treat it as an undervalue. It would be immediately, so we'd credit share capital with the full dollar, and we would debit whatever it was that we were receiving, tangible non-current assets, for instance, at the full dollar. We can't create a discount on share account because you can't issue shares at a discount. But private companies can effectively, by issuing shares in respect of non-cash consideration. It's not illegal, but it only applies to private companies. Okay, we move on then to share capital variation of class rights. Where shares are issued, there may be different classes of share. The main one is equity shares or ordinary shares. That's the big one. But so when shares are issued, or when a company is being created, the promoter has to decide what the share capital is going to be and how it's going to be subdivided, whether it's going to have just one class of share or a number of different classes of share. And the rights attached to each of those classes will be defined within the Constitution. It will be there within the articles and within the document that surrounded the share issue. Rights attached to a particular class of share refer to typically voting rights, entitlement to dividends, and return of capital in a distribution. Return of capital where we're facing typically liquidation, who's going to be paid in priority to others. If the variation of rights is specified in the Constitution, then that's what we do. If it tells us in the Constitution what mechanism, what procedure we need to follow in order to vary the class rights, then we follow the Constitution. If you're not happy, then you shouldn't have become a shareholder in the first place. It's your company. You are bound by the Constitution. The articles have contractual force on you as a member and as well as on the company. If it's not specified by the Constitution, then we need a special resolution. But the Constitution may say, no, we only need an ordinary resolution, or no, we need a resolution of 90% or 95%. But you cannot have class rights prevented from being altered. There always has to be a capability of altering class rights. Provisions apply even to companies without a share capital. Class rights could have class rights. You could have an unlimited company with share capital. You can have a guarantee company with share capital. Equally, a guarantee company without share capital, but you could have them with share capital. And to vary those class rights, we'd need special resolution or follow the articles, whatever the Constitution says.